beginning with the Better Life series. Self-improvement and financial education to manage your money and simplify your life. The power of artificial intelligence to transform the Simply Media library of over 900 ebook and audiobook titles to video. Please like, subscribe, and hit that bell to be the first to experience the magic of storytelling like never before. Thanks. Enjoy your video.
Investments for a Better Life by Deaver Brown, number 9 in the Better Life Simply Media series. Contents, Chapter 1, Introduction. Chapter 2, Starts with You and Your Budget. Chapter 3, Invest in Yourself, the place to start. Chapter 4, Your Choices in Education. Chapter 5, Your Budget. Chapter 6, Investing Habits. First, identify and align with your temperament. Chapter 7, Less Money in the Economy. Chapter 8, The Golden Few to Invest in. Chapter 9, Criteria for your stock choices. Chapter 10, Real Estate, Commodities, Bonds, and Collectibles. Chapter 11, The Golden Few, Which Stocks to Pick. Chapter 12, Summary. Chapter 13, Better Life eBooks and Audiobooks series. Chapter 1, Introduction. In this deflationary, automated world we live in now, your investment choices should be guided by which will prosper in these times. You also need to decide whether you believe this is a short or long-term trend to further inform your selections. And you need to be mindful of who will be president and control Congress, since 50% of U.S. voters back the party that wants to increase taxes substantially on business and individuals, which would directly reduce the returns on stocks, and increase taxes on individuals, which would substantially reduce money available for consumers and businesses to purchase or invest in anything. First, you should read our Better Life book, The New Depression, in our deflationary age, How to Protect Your Money. Second, recognize it is harder to preserve money than make it, as we routinely see athletes and formerly wealthy entrepreneurs go broke and even be forced into bankruptcy. John Train, the legendary investor in the generation before Buffett, wrote in his book, Preserving Capital, published by Macmillan and still available online, that preserving capital is harder than earning it. As an example, he used the 19th century fortunes, which have largely disappeared by being spent, taxed, invested unwisely, or gifted away. As he said ironically, 19th century fortunes are largely seen today in vineyard names, museum gifts, and other such items. Little is left for later heirs. Thirdly, and in summary, our goal here is first to protect your money. After working on that major issue, we will offer suggestions and strategies to expand your capital. Chapter 2 starts with you and your budget. Everything starts with you. Your earnings are the fuel for your investments, but your spending can bring you to ruin. The more you earn, the more this is true, because you can then acquire debt to finance personal assets, which can take you down quickly if your earnings fall off and your spending doesn't. So start with your budget. In short, spend less than you make so you can be the millionaire next door. 2 aphorisms come to mind. Charles Dickens, earn £20 a year, spend $19.5 and be happy. Spend $25 and be miserable. Ben Franklin, in Poor Richard's Almanac, a penny saved is a penny earned. This approach is easier said than done, so you have to be diligent to make this foundation for your wealth work for you. We cover this more thoroughly in Budget for a Better Life. Here we provide some suggestions. Your first step is not to let your spending get ahead of your earnings. Don't rely on future income growth to fund your expenditures in the present. Secondly, don't expand your housing footprint to anticipate needs such as children home offices, and the like. Thirdly, buy used vehicles versus new ones that lose 25% of their value when you drive them off the dealer's lot. You also must pay higher insurance and excise taxes on them. Fourthly, save money on the small things that add up, like brewing Starbucks at home versus stopping at Starbucks stores. Shop at Costco or Sam's to stock up, and buy only what you need, not impulse items. Chapter 3. Invest in yourself, the place to start. You are the founder of the feast. Investment should therefore start with you. In our audio and ebook titled Personal Finance, we describe this in detail. Now, in these automated, deflationary times, it is even more important to be mindful of your finances when you and others are challenged to find productive work, as so many trends are converging on organizations to eliminate jobs and reduce pay so they can be competitive and stay in business. Think of the game of musical chairs. People go around the table and there's one less seat. That's the image you should keep about these times. There are going to be fewer seats. And the way to get a seat is to be qualified to the best of your ability. The first area to consider is in education. For most jobs these days, companies from Walmart to Apple are not finding college degrees particularly helpful in most areas and believe they place unnecessary financial strains upon their workers. Be mindful that these two visionary companies believe this, who have gone through a series of business cycles and have continued to prosper through each one. Therefore, these adaptable organizations have come to believe this now, which is significant in itself and a shift from their point of view just 10 years ago, as they have pivoted here as they have elsewhere before to survive change and prosper accordingly. You can read or listen to more about the importance of pivoting and changing your point of view in our Better Life series and our title, Pivoting for a Better Life. Crucial to this approach is to keep an open mind to new things and other points of view. Socrates, considered the wisest person in the golden years of ancient Greece and our North Star for direction and thought in our Better Life series, said, "I go out every day to find out what is going on." Exactly what we all should do if we wish to learn and adapt to these challenging times. Your first step is to turn the chessboard around and see things from the opposite or at least different point of view. Whatever you do or believe, do this one thing consistently and you will prosper. Always remember, when doing this, you are thinking, not doing. You are seeing the wider perspective and spectrum of thoughts and choices. As they say in the military, don't marry your position. Be flexible and stay mobile in your thinking as well as in your actions and decisions. In schools and colleges' graduation, it is called commencement, or the beginning, not finalization or the end, though many adopt the latter point of view and stick to their perspective thereafter. This leads to Socrates' second great statement, made when the famous Delphic oracle named him the wisest person in ancient Greece. He was surprised at first, but then concluded, "Why? I know what I do not know." That is how we hope you will be guided, so you can be open to change, pivoting, rethinking, and more in your life. Our Better Life series is here to be one contributor to your success in this. And Mark Twain had a wonderful saying, as so many of his. He said, "You never get in trouble for what you know. You get in trouble for what you know that ain't so. So be careful." Humans are gifted with the unique ability to adapt, as Yuval Noah Harari wrote in his landmark book, Sapiens, A Brief History of Humankind. On a more pedestrian level than his noteworthy book, we hope here to leverage your ability to adapt through first investing in yourself. The next chapter extends these general ideas into specific suggestions to do this most successfully for yourself, starting with your education. Chapter 4, Your Choices in Education. Investing in your education is the first serious decision in this field. You are investing family money or your own with student debt if you go on to college or trade school. If you go further on to graduate school, it will be much more. Remember, you are also investing your time and youth in extending your education as well. You should decide this as you would decide whether to buy property, stocks, mutual funds, or starting a small business. As Stephen Covey wrote, you should have the end in mind. What result are you seeking, and at what cost? The book to read or listen to is Your Career for a Better Life. Briefly, you need to identify what work you like and what you don't, what your talents and temperament are compatible with, and what they are not. The best way to scope this out is to consult with your teachers, colleagues, friends, family, and adults who know you. They can give you invaluable advice through them. You must make the final decisions, though. Although their advice is not irrevocable, it is hard to turn away from. So be sure to consider it thoroughly. The first step is to decide whether to work alone or in groups. Do you want a safe profession with relatively predictable outcomes, such as in the trades, teaching, or administrative work, or do you like more risk and reward, challenges, such as going into sales or your own business? Once you've decided this, you should carefully review the education and cost required to reach your goals. With this done, you can move on to your other choices of investments. Chapter 5, Your Budget. Your budget surplus lets you invest. With no surplus or losses, you are excluded from this opportunity. Therefore, this is the first major fork in the road for you. You can learn more about this in our title, Budget for a Better Life, but this is a brief commentary. The place to start is Vanita von Caspel and her down-to-earth, practical money guide, Money Dynamics. She divides our lives into 3 stages: learning, earning, and yearning. Education fits neatly into the learning stage, and it is essential that you keep doing so throughout your life to align with opportunities to earn and invest. You can then have your earning stage where you must save enough to have a happy yearning or retirement final stage in your life. I would add that you must make enough before and after you have children at home to save enough for retirement or losing your job. It is very hard to do that when having children. Young people around the world are mindful of this as they increasingly have children later and fewer of them per adult. The simplest 5 budget investments you can make. First, no more apartment or house than you need. Second, use cars, not new ones. Third, morning coffee at home, not out. 4, more meals at home or packed for work and trips. 5, Costco, Sam's, or Walmart versus more expensive shopping. Be mindful of small savings. They add up and are simpler to achieve. Remember that budgets are a habit. Once you start them and comply with them for an extended period of time, they tend to become ironclad and second nature. Therefore, you must want to develop good ones early, or the bad ones will take you down. See Budget for a Better Life for more specific ideas, suggestions, and details on this subject. Chapter 6, Investing Habits. First, identify and align with your temperament. People don't generally pay attention to their habits and how it influences their budgeting, expenses, savings, and investments. We all should take that in account so we can align our decisions with our habits in these areas. Most people buy and spend in good times and save and sell in bad ones. This is the exact opposite behavior for you to save the most and have your investments grow. It is normal and the herd mentality. Your first step here is to acknowledge those pressures upon you. I have for a long time and benefited from it. My family members have not and usually press me to spend more in good times so we had less for rainy days. That is normal. So what steps can you take to avoid this pattern? The first is to be mindful of group pressures to do this. The second is to limit additional spending in good times so you can have more to invest then. The third is to invest the most when markets and prices are down, not when the market is up. Several great investors of old gave me the best tip. Invest when no one is talking about the market. Be wary when they are. Now, we will talk about economic factors that you should consider in your investing during these automated deflationary times. Chapter 7. Less Money in the Economy. The stay-at-home policy starting in early 2020 cut down on money creation from wages, closed retailers and restaurants, and taxes reliant upon them. Then the resulting bankruptcies cut down on money from investments as canceled debts, and the value of these firms were eliminated or substantially reduced. In short, people, businesses, and investors in general have less money now and for the foreseeable future to spend or invest. Hence, most investment values are going down as assets such as houses, businesses, and other such things are declining overall because potential buyers don't have as much money to invest in the assets or buy them as before. Then the convergence of the PC and internet has led to reduced costs as people and businesses have automated and gone online to save time and money. This has saved money largely through a continual process of automation, leading to job and property eliminations, such as with 77 branch banks in 2018, now reduced to 38,000, obsoleting 9.5 million square feet of retail space and the people formerly working there. Teller deposits cost banks 38 cents each, plus an extra 20 cents, while photo deposits cost just 3 cents each, and ACH ones, what 98% of simply customers use, cost nothing. Similarly, other branch offices are closing, such as tax preparers, investment and insurance firms, and others. This has led to less wages and hence less money put into the economy, though the companies doing the closing have benefited substantially in their profits. Your challenge as an investor is to find these bright spots as investment opportunities and avoid the struggling ones. The final factor here is to identify whether you believe this is a short-term trend or a long one. The impact of the virus may be short. Chapter 7. Less Money in the Economy. The stay-at-home policy starting in early 2020 cut down on money creation from wages, closed retailers and restaurants, and taxes reliant upon them. Then the resulting bankruptcies cut down on money from investments as canceled debts, and the value of these firms were eliminated or substantially reduced. In short, people, businesses, and investors in general have less money now and for the foreseeable future to spend or invest. Hence, most investment values are going down medium term. But the convergence of the PC and internet is more like the impact of the railroad in America from 1865 until the start of World War I in 1914 that reignited spending, the money supply, wages, employment, and more. During this 49-year period, deflation and cost declined 70%, and the country experienced repeated severe recessions, violent labor disputes, and more economic disruptions. That seems the more probable outcome for our current period. Consider why it took 30 to 40 years for the railroad to start to have its impact in 1865. As Peter Drucker has said, it takes 25 years or longer for major innovations to take form, such as the PC, which launched in 1975 by Apple, but only started to become the deflationary automated force it was expected to be then in 2000. Amazon launched with the internet in 1995, and 25 years later it has become a massive deflationary force across the economy, with AWS and Go stores massively starting to automate IT and store checkout, where there are 13 million workers. Sounds bad, doesn't it? But the first massive American fortunes were built in this 1865 to 1914 period, such as Carnegie, Rockefeller, and the young Henry Ford. Similarly, the massive internet fortunes are being made now with Bezos, Zuckerberg, and others. The Chinese symbol for crisis contains smaller symbols, two of them: opportunity and danger. Be mindful of that as you navigate through this crisis to seek opportunity in order to avoid danger. Your opportunity here is in a stock market now that you can invest in to ride that opportunity wave. That is what we want to help you do here and in other Better Life books. Chapter 8, The Golden Few to Invest in. Historically, the most successful companies have been those that innovated while relentlessly reducing their costs. Rockefeller did that with oil, Carnegie with steel, and Henry Ford with cars. Walton did that with physical retail stores, Bezos with online retail, and IT AWS. Microsoft with the Windows operating system, Jobs with the Apple ecostructure, Zuckerberg with social networking, Costco in bulk retail. I have had similar success on a far smaller scale with the Embroller Stroller, APC with UPSs, and now Simply Media with eBooks and Audiobooks. Hence, I have had first-hand experience with how being the low-cost provider gives companies enormous opportunities to ride out downturns, management errors, product issues, and the like. Our current challenging economy has all of the elements of consumer and business demand for low prices in general, especially in downturns, which has the above-named entrepreneurs doing very well, and they always benefited from in the past and now. So the golden few are those that follow the success model from Rockefeller and Carnegie to Bezos and Zuckerberg. They have consistently grown in face of competition as a result. They do so through their low costs, weakening their competitors who must drop their prices to remain competitive without the corresponding benefit of lower costs. Most of these weaker competitors are absorbed into the golden few, liquidated, or disappear into the land of the living dead, like formerly great Sears and Barnes & Noble. The next chapter will discuss how to pick these companies, invest, and be mindful if they shift their strategy and move up in price. Chapter 9, Criteria for your stock choices. In a deflationary automated economy such as this one, preserving capital is a gain because prices and salaries tend to go down together, which means anything that holds its value is worth more next year than this year. The evidence suggests this is true, since Wall Street is buying less than 1% interest on 30-year government bonds, indicating they expect no inflation for 30 years. A remarkable bet these days, but not historically, so as in the late 19th century in America. Historically, investors seek to make 3% net of risk on their safe investments, such as 30-year U.S. government long bonds. Hence, Wall Street is betting that deflation will be approximately 3% per year for 30 years, much like what actually occurred in late 19th century America. In short, this is a solid projection by experts based on similar circumstances when the railroad drove down costs then as the combination of the PC and internet are doing now and for the foreseeable future. So we are down to recommending the golden few. First, though, we must address other kinds of investments and why they are more risky based on the fundamental deflationary and automated economy today. Chapter 10: Real Estate, Commodities, Bonds, and Collectibles. Real estate is particularly challenging during these times as we have seen the deep blue state and city evacuation rolling on since 2017 when the state tax deductions were capped at $10,000 for individuals, corporate taxes cut to 21%, and individual federal tax cut, making the general market a better place to invest. Many millennials wisely held off buying real estate to invest in the market, which rewarded them handsomely for doing so. The risk for commercial real estate is already clear, with so many branches and closing already to take advantage of PC and online cost savings, department store closings, weaker retailers' bankruptcies and late rent payments, and smaller stores and restaurants disappearing even before the stay-at-home government requirements. This trend is getting more intense as investors increasingly recognize this is not a short-term trend they can bridge, but a long-term decline. These losses reverberate through the economy, such as making shopping malls less attractive to visit and weaken their owners' finances too. Personal real estate is challenged as there is less money available to buy anything, including property, paying the carrying costs, and more. Rental prices are dropping, making them increasingly more attractive than owning, as well as the political push for free rent, rent control, and more negatives for these owners. This is even more intense for high-cost areas such as San Francisco, where rents have already dropped 12% year over year due to people not paying their rent, postponement of evictions, and blue city and state evacuations to lower-cost areas as companies such as Facebook are already experimenting by farming out work to lower-cost red states as IBM and others have farmed out IT work to India and other low-cost countries around the world for decades. Commodities and collectibles always do poorly in deflationary times, as we have already seen with oil and gas prices. Bonds are risky because most solid stocks pay higher dividends than solid bond offers. Hence, we are back to the golden few stocks. Chapter 11: The Golden Few, Which Stocks to Pick. The place to start is the FAANG Group: Facebook, Amazon, Apple, Netflix, and Google. Other candidates are Microsoft, Walmart, PayPal, Visa, MasterCard, McDonald's, Starbucks, TJX, Ross, and Home Depot. Happily, 6 to 8 stocks give you ample diversity while letting you keep track of their goings-on comfortably without detracting from your work and other activities. Why these 15? Each one is committed to low costs, prudent acquisitions to increase their market share and cost leverage, and have solid customer bases that are loyal to them for these reasons. These are called networks, generally. Now, let's apply the wisdom of the best professional advisors about how to pick your 6 to 8 and manage them going forward. Warren Buffett: the stocks I pick, I plan to own forever. Peter Lynch: don't sell the stock unless the story changes. Vanita von Caspel: pick stocks you understand, never ones you don't. Mine. Never day trade. That's for pros, and they usually lose over time. A final thought. Stock buybacks are attractive because you get more stock tax-free until you sell, unlike your dividends, which are immediately taxable. That is often the deciding factor in stock selection for Buffett and other pros. I follow that advice personally myself. Chapter 12, Summary. Re-listen to this annually at a minimum. If professional athletes can go annually to training camps, so can we. Read widely and don't be an overactive investor. When Buffett was asked how he could have made more money, he said, "Sat longer on the porch, been less active, read even more widely than I do now." And a final point, why no funds? They take a minimum of 1% a year or a third of the growth professional investors hope for, 3% a year. Thus, we don't recommend them. Good investing from us at Simply, and me as the author and narrator.
The Better Life ebook and audiobook series and the entire 900 ebook and audiobook Simply Media library are yours for less than the price of a cup of coffee for $2.99 per title at simplymedia.com and available on Kindle, Audible, Walmart.com, Google, Apple, and other Simply customers listed on our website. Coming soon from visualbookshelf.com. More videos in the Better Life series. Visit visualbookshelf.com for free copies of individual Better Life ebook and audiobook titles, as well as complete ebooks of the Better Life collection. So you can join us in bringing books to life on video. Register at the website for coupons for more free stuff and to be the first to access new videos as they arrive.